Section 1. The most important first step. Building your foundation. Folks, let's talk straight. You hear the word investing, and your mind might jump to Wall Street guys in fancy suits, confusing charts, big scary numbers on a ticker. You think you need a pile of cash to even get in the game. That is a lie. That kind of thinking has kept too many good people on the sidelines, living paycheck to paycheck and wondering if they'll ever get ahead. The truth is, you can start building wealth with as little as $100. But before you put that money to work, we have to build a solid foundation. You would never build a house on sand, right? You build it on solid rock. Your financial life is no different. Prepare for the storms of life before you start planting for the future. The first step, the absolute non-negotiable, is to build a safety net. This is your emergency fund. Life happens. The transmission goes out. The air conditioner breaks in the middle of July. You get a medical bill you didn't expect. These aren't if events, they are when events. Without a buffer of cash, these little emergencies turn into full-blown crises. You end up reaching for a credit card, digging yourself into a deeper hole, selling your investments at the worst possible time just to stay afloat. That is not a plan. That is a recipe for disaster. We're going to end that cycle today. Your first goal, a baby emergency fund. Scrape together $1,000 as fast as you can. Sell stuff you don't need on Facebook Marketplace. Pick up extra hours at work. Deliver pizzas on the weekend. Do whatever it takes to get that first $1,000 saved in a separate savings account. This isn't your vacation fund or your car fund. This money has one job and one job only, to protect you from life's little surprises. It's the wall between you and debt. It gives you peace of mind and breathing room to make smart decisions, not desperate ones. Once you have that $1,000 starter emergency fund, you've taken the single most important step toward financial peace. You've changed your mindset from reactive to proactive. You're no longer a victim of your circumstances. You're in control. Section 2. Your first investment isn't in the stock market. All right, you've got your starter emergency fund in place. You're feeling a little bit of calm for the first time in a long time. Now, are you ready to invest that $100? Not yet. I know you're eager, but we have to deal with the single biggest obstacle to building wealth: high-interest debt. Folks, you cannot out-invest stupid. Paying 24% interest on a credit card while trying to earn 10% in the stock market, like running up a down escalator. You're working hard, you're sweating, but you are not getting anywhere. You are losing ground with every single step. Your first and most powerful investment is paying off your own debt. If you have a credit card with a $5,000 balance at 20% interest, that debt is costing you $1,000 a year in interest. That's money flying out the window. Pay off that debt and you get a guaranteed 20% return. Can you get that in the stock market? No way. Not without wild, foolish risk. Paying off your debt is the safest, fastest, most certain way to improve your financial situation. It frees up your most powerful wealth-building tool, your income. Here's the plan. After your $1,000 emergency fund, attack your debt with the intensity of a gazelle running from a cheetah. This is the debt snowball. Congratulations! You have your emergency fund and you've cleaned up the mess of high-interest debt. Now your income is yours. It's time to finally put that $100 and every dollar after it to work building your future. So where does it go? You don't need a finance degree and you don't need to be a stock-picking genius. The secret to successful investing for normal people like us is to keep it simple and boring. Boring is beautiful when it comes to your money. We are not looking for the hot tip or the next big thing. We are looking for slow, steady, proven growth over a long period. That is how real wealth is built. For beginners, the best place to start is with low-cost index funds or ETFs. Don't let the names scare you. The idea is incredibly simple. An index fund is like a big basket that holds a tiny piece of hundreds or even thousands of the largest companies in the country. For example, an S&P 500 index fund owns a small slice of the 500 biggest companies in America. When you buy a share of that fund, you instantly own a piece of Apple, Microsoft, Amazon, and 497 other successful businesses. You are not betting on one horse to win the race. You are betting on the whole American economy to grow over time. This approach does two very important things. First, it gives you instant diversification. Now that you know what to buy simple, low-cost index funds, let's talk about how to buy them. The secret ingredient that turns a small amount of money into a fortune is not luck or genius timing. It is consistency and time. You have heard of compound interest, where your earnings start to earn their own earnings. It is a powerful force, but it needs two things to work its magic. Fuel, your consistent contributions, runway, a long period of time. This is why starting now, even with just $100, is more important than waiting until you have thousands. A small amount invested early is more powerful than a large amount invested late. The best way to be consistent is to make it automatic. This is called dollar cost averaging. It sounds fancy, but it just means you invest the same amount on the same day every month, no matter what the market is doing. Set up an automatic transfer from checking to investing $100, $200, or whatever you can afford. When you do this, you take emotion out of the equation. You're not trying to time the market. That's a fool's game. You are buying steadily, month in, month out. This has a hidden benefit. When the market is down, your fixed dollar buys more shares. When the market is up, your same dollar buys fewer shares. Over time, this lowers your average price per share. But the real power is the habit it creates. Investing stops being a decision, it's automatic. Like paying the electricity bill. It becomes a passive background process working for you 24/7. Simple math. Invest $100 each month at a 10% average annual return. After 40 years, you would have over $530,000. Your contributions were only $48,000. The remaining $482,000 is pure growth. That's compounding. That's the power of starting small and staying consistent. This isn't get rich quick, it's get rich for sure. So, how do you buy these funds? You can open an account with a simple, low-cost brokerage firm online. Companies like Fidelity, Vanguard, or Charles Schwab make it easy to get started. Another great option is to use your workplace retirement plan, like a 401k. If your employer offers a match, that is free money. You must contribute at least enough to get the full match. Inside your 401k, look for options like an S&P 500 index fund or a target date fund. A target date fund automatically adjusts its mix of investments to be more conservative as you get closer to retirement. It is a great set-it-and-forget-it option. The key is to choose good, growth stock mutual funds with a long track record. Second, these funds are cheap. They are passively managed, meaning a computer is just tracking the index, so the fees or expense ratios are incredibly low. High fees are a cancer on your returns, and we want to avoid them at all costs. Choose low-cost index funds and automate your contributions. Simple, boring, effective. You have a plan. You're investing automatically every month into good, low-cost funds. You are on the right path. The journey is long. There are two enemies that will try to knock you off course. Fees, fear. These two thieves can rob you of hundreds of thousands over your lifetime, but we are not going to let them. We will understand them. We will face them. We will defeat them with a clear, disciplined strategy. Let's start with fees. They are silent killers of wealth. Small percentages that add up to a fortune over time. Imagine two otherwise identical funds. Fund A, expense ratio 1%. Fund B, expense ratio 0.1%. That 0.9% difference sounds tiny. But over 40 years on $100,000, it can cost you over $150,000. The money goes to the fund company instead of compounding in your account. Choose low-cost index funds. Always ask about fees. Look for the expense ratio. If it's over 1%, run away. Keep as much of your own money as possible. The second enemy lives inside your head. Fear. The market is not a straight lineup. It goes up and down. Sometimes it drops a lot, very fast. The news will scream crash. Your account balance will fall. Your stomach will churn and a voice will tell you to sell everything. This is the moment of maximum danger. Panicking and selling locks in losses. You guarantee you'll miss the recovery. For long-term investing, a downturn is a temporary sale. Companies are on discount. Your automatic monthly investment buys more shares at lower prices. You must have the courage and discipline to stay the course. Do not watch the daily news. Do not check your balance every day. Make a plan and stick to it. You're a long-term investor, not a day trader. Control fear and keep fees low to protect your wealth and give your plan a chance to succeed. We have covered a lot of ground, but it all boils down to a few simple, powerful truths. Building wealth is not complicated. It does not require a fancy degree. It does not require a secret handshake. It requires a plan. It requires discipline. It requires a commitment to start now. You do not need to wait until you have a lot of money. You can start the journey from broke to millionaire with the very next dollar you earn. Build a starter emergency fund. Destroy your high-interest debt. Begin investing 15% of your income into low-cost growth stock mutual funds. That is the plan. It has worked for millions of people. It will work for you. The path to wealth is paved with small, consistent actions taken over a long period. Automate good habits. Build your future on autopilot. You save first. You pay off debt with intensity. You invest for the long haul in simple, boring index funds. You ignore the noise. You control your fear. You let compound growth work its quiet magic over decades. This isn't a race. It's a marathon. Slow and steady wins every single time. Start with $100 today and invest consistently versus waiting 10 years to start with $10,000. The enemy isn't lack of knowledge, it's lack of action. Procrastination is the thief of dreams. You can read 100 books, you can listen to 1,000 podcasts, but nothing changes until you take the first step. The feeling of being in control of your money is worth more than a fancy car or a vacation. It's financial peace. Freedom to live and give like no one else. You are capable of achieving it. Decide you are done with the way things have been. Decide you are ready to build a new future for yourself and your family. So what is your next step? Not next week. Not tomorrow. Today. Right now. Open a separate savings account. Set up an automatic transfer. Start with your first $25 or $50 toward your $1,000 starter emergency fund. That is it.